Do you personally expect a recession?
I am going to defer to my economist at this point, but I think probably that's a likely outcome. Normally, I don't pay that much attention to anecdotes, but you heard them. They're real. I hear it from just everybody now. I'm going to cut back a little bit. I'm going to wait, see what happens. That is kind of recessionary talk. So, we've been in this kind of very soft landing for a long time. Consumers have money, they were spending money, corporate is making profits. I do remind people part of that was because of our extraordinary fiscal spending. We borrowed and spent $11 trillion since COVID. And that obviously drives a lot of growth, it drives corporate profits. So I think what we're going to see now is corporations making announcement after announcement about, don't expect my guidance to be true, I'm going to hold back here a little bit. These are long-term decisions they have to make. They may want to see the tax bill, which hopefully they can get done in July. So yeah, I think you're going to see a slowdown. I think the economists are probably right to say that you should expect that. And the other thing, which we haven't had any slowdown or real recession, and COVID was so short, I almost don't include it, and so long that if you have rates going up a little bit, and inflation is sticky, and credit spreads are gapping out, which they're going to, I think you'll see more credit problems than people have seen in a long time. I always remind people, markets aren't always right, but sometimes they are right. And I think this time they are right because they're just pricing in uncertainty at the macro level and uncertainty at the micro level, the actual company level. And then how it affects consumer sentiment, it's hard to tell. Consumers still have jobs, wages are going up at the low end, which I think is a good thing. But if companies start cutting back, yeah, the consumer sentiment changes and business sentiment changes. I think you've already seen business sentiment change a little bit. Hopefully, no one's wishing for that, but hopefully if there is one, it'll be short. But I do think fixing these tariff issues and trade issues would be a good thing to do. That will get one major uncertainty behind us. We have the strongest economy in the world. It would be good not to add to the uncertainty out there. Trade is really complicated. These trade agreements are thousands of pages long. It is product by product and area by area, non-trade barriers, subsidies. There's tons of food. If you spend time with just food alone, you'd be shocked how many different food agreements there are and disagreements and protection of local farmers, which almost every country does. So the sooner, the better. They should get at it. That just slows everything down. And so that's the bad part of these volatile markets. It's not that it's bad for us. It's bad for small businesses, middle-sized companies. Large companies can usually get the funding they need. Well, it's nothing like '08 in clarity. And the 2000 dot-com thing was very brief. It lasted like 9 months or something like that. So it doesn't compare to that. The world was massively over-leveraged. There was a mortgage problem. You're going to have, $500 billion or maybe $1 trillion of actual real problems. The banking system's not that leveraged today, but it's serious. And it was serious before the last election. We have a huge, complex geopolitical situation, huge fiscal deficits, not just here, but around the world, sticky inflation, which I personally think will not go away so quick. And then you have, what's going to happen to tariffs, what's going to happen to trade, what's going to happen. So, tariffs and trade are just part of that mix. They don't completely stand alone. I think it is perfectly reasonable for someone to say that trade was unfair. There were unfair trade things. And remember, it's not just tariffs. It's tariffs. I think they have the VAT wrong, how they understand it. And I think they should really get a better understanding to make it easy to negotiate. But there are all these non-tariff barriers around food and energy, and then subsidies, which China is famous for. So it's totally reasonable to say we want to make trade better. But I also want to point out to the Americans, we have the best economy in the world. Our GDP per person is $85,000. China's is $15,000. So you got to put a little bit in the context. And then, of course, when they put the tariffs in, that was way beyond what people expected. That will cause a little inflation, slow down growth. But I hope what they really do is let Scott Bessent, who I think is a professional, negotiate. I know Japan's here, I gather Korea, Vietnam have called, and then eventually Europe. Get those things done quickly. If you want to calm down the markets, show progress in those things, and let Scott take the time. Trade deals are very large and very complex. They can't be done overnight, but you really have to have teams working on them to get them right. I'm taking a calm view, but I think it could get worse if we don't make some progress here. And of course, trade wars, you saw China raise their rates today, and people are going to get angry and they're going to have responses, and every country's got choices. So there are short-term choices, there are long-term choices. And I also want to point out, if you kind of look forward, in the next 60 days, every company is going to be telling you guys, what it means to them. I think today I saw Delta remove their guidance. And things like that will affect stock prices again. It's not over yet. And then you've seen tremendous moves in swap prices, asset prices, treasury prices. There's a 10-year treasury auction today and how they go. So let them settle down, take a deep breath, negotiate some trade deals. That's the best thing they can do. You have a lot of deleveraging hedge funds and players out there, which he obviously is quite experienced with things like that. And that is the initial effect. There will be other effects, and we still are the reserve currency, which will be true for a long time. But a very important point, China and Russia have made it clear they want to kind of dismantle the post-World War II system. And I think the goal of all this trade stuff should be to make Europe and our trading partners, Japan, Korea, Philippines, stronger, not weaker, bring them closer as we build up our military. And any trade that protects military, that we should definitely do.
I have said before, and I would repeat it again, if it's not going to zero, it's going to 1 million. It's either nothing, right? If it's nothing, then it's getting scrubbed out and banned. And of course, we now know that it's not getting banned, right? There's no way that Fidelity, Citadel, BlackRock, Charles Schwab, Deutsche Bank, Credit Agricole, Banco Santander all decide they're interested in this, right? They're not endorsing a tulip bulb, right? So once you go from 0 to 1, then the question is, okay, well, it's an asset class. If it's not going away, then what's it worth? Well, it's worth 1% of the assets in the world. So 1% drives it up by a factor of 10 to 20, right? Once you get to a 1% exposure. The recognition as an asset class is a big deal. The availability of a spot ETF is a big deal. The normalization of accounting via fair value accounting, which is the FASB initiative, it's another big deal. And then the halving is a big deal. So those are 4 pretty serious milestones that we're staring at right now. And I think Wall Street and the general community is kind of just internalizing this all in a short period of time. And that's why the bullish outlook. So you're a normal person and you want to save money for retirement or to give to your kids. So you put it in a savings account, you get 5% interest. The monetary inflation rate is 7 or 8 or 9%. You got a negative real yield of 3%. If you end up with a negative real yield of 3.5%, then over 100 years, $1 million saved is worth $30,000. Okay. And so for the average person, saving money in bonds with a 3.5% or 4% interest rate when the currency expands at 7 or 8, that's a losing proposition. You lose 97% of your wealth over the course of 3 generations. So clearly bonds, they don't work, right? And savings accounts don't work. So the next question is, do I just put all my excess money in the S&P index? Well, traditionally, the money supply in the US is expanding at 7% and the S&P index is going up at 7%. So if you save $1 million over the course of your life and you put it all in the S&P index, then in 100 years, it'll be worth $1 million. So that's wealth preservation, but you're not doing any better than that. And that just kind of assumes that the S&P 500 is going to be relevant for 100 years and you can stick around the country. But it's like treading water. The next issue is, well, so what I put in real estate? If you buy real estate, you're an average person. Can you buy a building? Probably not. Can you buy a warehouse? Not easy. Maybe if you're a rich family, you buy warehouses, right? Rich families buy warehouses, city blocks, and buildings, but the middle class person doesn't. So how do you buy $4,000 worth of a building? Can't. Okay. So the issue there is your property rights are inferior when you're buying shares of stock or a security versus the underlying property. If you own the building, you can mortgage the building, sell the building, upgrade the building, build 10 floors above the parking lot that the building has. You can develop the building. When you own a share in a REIT that owns the building, like you own 1/100th of the building, you don't have any of those rights. You can't do anything to the building. You're just along for the ride, getting 1/100th of whatever cash flow the general partner decides to distribute to you. And if they make stupid decisions, you're stuck with them, right? You don't have any property rights. You're inferior in your economic rights. So owning shares of a REIT to get property for 100 years, not a great idea. And that leads us to the problem of securities. What is the problem of security? So you have some money, you invest it in Apple stock or Amazon or Facebook or Google or a REIT that owns a building. The dilutive problem with securities is there are risk factors. First of all, there's a management team. They're going to take 1% every year. They're not doing it for free. They're charging you to manage the company or the building, right? And if you're lucky, that's only 1%. You want to see that in action? Just go look at any ETF. The ETFs charge 90 basis points. If you want to put money into a Bitcoin, Bito, or whatever, they'll charge you 90 basis points just as the management fee. So about 1%. What's the cost of 1% over the course of a lifetime? An infinite duration asset, you would basically multiply it by 20, 25. So it means that when I charge you 1% to manage your $1 million, I'm taking 20% of your money, okay? I'm taking 20% of all your wealth to charge you 1%. So that's only the first problem. It turns out that when you run a company, you also have the risk of labor, right? Your company may unionize. So you've got labor expenses. And what happens to the equity value when the company unionizes? Well, the union just takes all the profits. And the equity values of those companies start to trend towards zero. So labor is another risk. The third risk is your competitors, right? Your competitor may come up with a better product and you end up like Yahoo squeezed out or AOL squeezed out by Google. Well, then your stock's going to zero, right? I mean, how many companies actually had a competitor? Xerox, Kodak, world's full of great companies. Where are they today? They end up getting squeezed by competition.